If you have a financial goal that is due in, let's say, 5 years from now, and you are trying to achieve this financial goal through a SIP investment over the next 5 years, then you are taking a very grave risk. Because history shows us that if your SIP is coming to an end at a time when the market is witnessing very strong rallies, then not a problem. You can end up with returns as high as 45% per annum. But God forbid, if your SIP is coming to an end at a time when the market is going through a very steep correction, then you can also end up with negative returns, which in turn would almost certainly mean that you will fall short of the amount that you are targeting at the end of your 5-year SIP to achieve your financial goal. But don't worry, there is a solution. There are some very simple tweaks that you can apply to a conventional SIP-based investment approach through which you can ensure that you can successfully achieve your financial goal even if there is a large market correction during the course of your investment horizon. Hello everyone. Welcome to the part 2 of this series, where we are discussing if there is a way to invest in Indian equity markets through the SIP route such that we can end up with at least a low double-digit return, 11 to 12% per annum at the end of a 5-year SIP, irrespective of how market conditions were during the course of our 5-year investment horizon. In part 1 of this series, we examine some of the fatal flaws of a conventional SIP-based investment approach and how some of these flaws have grave implications, especially if you have a financial goal that is due in, let's say, 5 years from now, and you're trying to achieve this financial goal through a SIP investment over the next 5 years. Because if you look at the historical performance of a 5-year SIP in the Nifty, you would see that the outcome of a 5-year SIP depends on only one factor, which is market conditions at the time the SIP is coming to an end. If your 5-year SIP is coming to an end at a time when the market is experiencing very strong rallies, then you could end up with returns as high as 45% per annum. But if your 5-year SIP is coming to an end at a time when the market is going through a very steep crash, then you could also end up with negative returns. And the implications of that would be you will most probably not be able to successfully achieve your financial goal. You will most probably not be able to achieve the amount that you are targeting at the end of your 5-year SIP. So this is what you get with a SIP-based investment approach. Is there a way to do better than this? Is there a way to invest in Indian equity markets to achieve a financial goal that is due in 5 years from now in such a way such that even if there's a large market correction, a large market crash, anytime over the next 5 years, even then we are able to clock at least a low double-digit return of 11 to 12% per annum over the next 5 years, because that is going to be critical if we have to successfully achieve the financial goal for which we are investing at the end of our 5-year investment horizon. So far, we have discussed the historical outcome of a 5-year SIP in the Nifty. SIP by definition is a timing agnostic way of investing in equity markets. You're not trying to time the markets. You are basically trying to invest a fixed amount for a very long period of time at monthly intervals without caring whether the markets are at an all-time high or the markets are going through a downturn. Now let's see what is the kind of outcome we can achieve by introducing an element of timing into our investments. What do I mean by timing? By timing, I mean during times when markets are very, very overvalued, or during times when liquidity conditions are very, very tight. During such times, we get out of markets. And vice versa, during times when markets are very, very undervalued, or during times when liquidity conditions are very easy, during such times, we dramatically increase the allocation of equity in our investment portfolio. Now, I know what you must be thinking at this stage. You must be wondering whether that's even possible to achieve, right? Because most experts are of the opinion that it's almost impossible to time the markets, and that retail investors in particular should not even try to do that, right? So who's right? So I'm not going to make any assertions here. I'm simply going to present to you hard data on what is the kind of outcome that can be achieved by introducing an element of timing into our investments. And then I'm going to leave it for you to decide whether that outcome represents a tangible improvement over the outcome that is possible with a conventional SIP-based investment approach. So how can we go about timing the markets? Of course, you need a scientific logic to time the markets. What is it that constitutes a scientific logic? You basically need to look for market parameters through which you can potentially predict the future direction of markets. So the first parameter, which is part of our market timing logic, is something called PE ratio. PE ratio stands for price to earnings ratio. So let's first understand what exactly is PE ratio. Now, every company's share has a P ratio. P ratio, as the name suggests, is a ratio. It has a numerator P, which stands for price. It has a denominator E, which stands for earnings. How do we go about calculating the P ratio in case of any stock? Let's take the example of a company A. Let's say its shares are currently trading at a price of 20 rupees per share. Let's also assume that there are a total of 1 crore shares of this company in total that are held by all the shareholders of this company put together. Now let's say if you want to buy all these 1 crore shares of this company and you want to become the 100% owner of this company. In that case, what is the price that you will have to pay? The price that you will have to pay would be 20 rupees, which is the price of one share, multiplied by 1 crore, which is the total number of shares of this company, which is equal to 20 crores. So this 20 crores is what represents the P in the P ratio of this particular stock of company A. Now let's move to the denominator, earnings E. E, which stands for earnings, is nothing but the profit generated by this company over the last 1 year. Let's say this company A, made a profit of 1 crore rupees over the last 12 months. So in this particular case, earnings E is equal to 1 crore. Now based on this, we can very easily calculate the P ratio of this stock. P ratio is price P divided by earnings E, which is equal to 20 crores by 1 crore, which comes to 20. So the P ratio of this particular stock is 20. Another important thing that you need to understand about the P ratio of any stock is that the numerator P, which is the price of the stock, is not a static number. The price of the stock changes on every trading day. And since the numerator in the P ratio changes every day, the P ratio of the stock also changes every day. Now let's see how the P ratio of a stock can potentially tell us whether the stock is overvalued or undervalued. Now in case of company A, we just saw that the prevailing P ratio of this stock is 20 crore by 1 crore, which is equal to 20. Let's say over the next 1 year, the profits of this company goes up by 10%. It goes up from 1 crore to 1.1 crore. And in response to this 10% increase in the profits of this company, the share price of this company also goes up by 10%. It goes up from 20 rupees to 22 rupees. And as a result, the numerator P of the P ratio goes up by 10% from 20 crore. It goes up to 22 crores. Now, what is the new P ratio of this stock? The new P ratio of this stock is 22 crores divided by 1 crore, which is equal to 20. So as you can see, the P ratio of this stock has remained the same. And how did this happen? It happened because the profits of this company went up by 10% and the share price of this company also went up by exactly the same 10%. Now, this is how ideally the share price of a company should behave. A share price of a company should roughly go up and down in line with how the profits of the company are going up or down. But this is what happens in an ideal scenario. In the real world, you hardly get these kind of ideal outcomes. In the real world, what could well happen is that when the profits of this company goes up by 10% from 1 crore to 1.1 crore, the share price could go up by as much as 50%. It could go up from 20 to as high as 30 rupees per share. And as a result, what would happen is that the numerator P of the P ratio would go up from 20 crores to 30 crores. Now, in this scenario, what is the new P ratio of the stock? The new P ratio of the stock is 30 crore divided by 1.1 crore, which is equal to 27.3. Now, as you can see, in this scenario, there has been a significant increase in the P ratio of the stock between year 1 and year 2. The P ratio of the stock has gone up from 20 to 27.3. And what does the increase in P ratio of the stock imply? A significant increase in P ratio of a stock implies that the share price increase has increased disproportionately compared to the earnings growth of the company. So the profits of the company has gone up by 10%, but the share price has gone up by as much as 50%. And usually when that happens, it's usually believed that such a share price increase is not completely backed by fundamentals. If the share price increase is not completely backed by fundamentals, there's a possibility that this share is overvalued. And if the share is overvalued, then there's a high probability that we could see a correction in this stock. There's another outcome that you can potentially get in the real world. Let's say the profits of this company goes up by 10% from 1 crore to 1.1 crore. But in response to this profit growth of 10%, the share price of this company doesn't move at all. It remains the same, 20 rupees. And as a result, the P in the P ratio remains the same. 20 crore remains 20 crores. So in year 2, the new P ratio of this stock is now 20 crore divided by 1.1 crore. The new P ratio is 18.2. So we see a decline in P ratio from 20 to 18.2. What does a decline in P ratio of a stock imply? A decline in P ratio of a stock implies that the share price of the company has not gone up in tandem with profit growth of the company. And when that happens, that potentially indicates that this particular stock is possibly undervalued. And if a stock is undervalued, then there's a very high chance that we could see a rally in this stock. Now let's see if we can use this understanding of the P ratio to predict the future direction of the Nifty 50 index, which is the primary stock market index of India. Now we just saw that in case of any stock, the P ratio of the Nifty depends on the numerator P, the price of the stock. And the price of the stock changes every day, and therefore the P ratio of the stock also changes every day. On the Nifty 50 index, we have the 50 largest companies of the country listed. And each of these 50 stocks have their own P ratios on any given day. If you take the average of the P ratios of these 50 stocks on any given day, you will get the P ratio of the Nifty itself on that day. And since the P ratios of these 50 stocks keep on changing every day, the P ratio of the Nifty also changes every day. So what you see on the screen right now is a red line which represents the P ratio of the Nifty over the last 25 years. As you can see, the long-term average of the P ratio of the Nifty over the last 25 years has been about 20. On the higher side, the P ratio of the Nifty has gone to little over 28. On the lower side, the Nifty's P ratio has gone to a low of 12.3 in 2001 and then to an all-time low of 10.68 in 2008. How does the P ratio of the Nifty tell us whether the Nifty is overvalued or undervalued? Well, whenever the P ratio of the Nifty keeps on going farther away from its long-term average on the higher side, the long-term average of the Nifty PE is about 20. Whenever the prevailing Nifty PE keeps on going farther away from 20 on the higher side, then it's believed that the Nifty is becoming progressively overvalued. And whenever it goes to the super high levels of 27, 28, those are times when the Nifty is considered to be very, very overvalued. In the same vein, whenever the P ratio of the Nifty goes farther away from its long-term average of 20 on the lower side, those are times when the Nifty is believed to be becoming progressively more and more undervalued. Whenever the P ratio of the Nifty drops to these super low levels of 12.3, 10.68, these are times when the Nifty is considered to be very, very undervalued. Now, how can we use this understanding of the P ratio of the Nifty to predict the future direction of the Nifty itself? Let's check that out. The blue line that you see on your screen right now represents the Nifty itself over the last 25 years. Now, there is something very remarkable coming out from this chart, which is that all the large market crashes that we have seen over the last 25 years have all happened after the P ratio of the Nifty went above 28. For example, the first time the P ratio of the Nifty went above 28 was in February of 2000. And as soon as that happened, we got a 51% correction in the Nifty over the next 1.5 years. The Nifty dropped from 1756 points down to 854 points. The second time the P ratio of the Nifty went above 28 was in January of 2008. And as soon as that happened, it was followed by a very painful 60% correction in the Nifty. By the way, this has been the steepest correction in the history of the Nifty so far. The Nifty corrected from 6,288 points in January 2008 down to almost 2,500 points by October of 2008. The third time the P ratio of the Nifty went above 28 was just before the COVID pandemic. Now, back in 2019, when the P ratio of the Nifty went above 28, nobody could have predicted that a pandemic of the scale of COVID is coming and that is going to lead to a large market correction. But if you are looking at the Nifty through the lens of its P ratio, you could have got a sense that the Nifty is possibly overvalued, and historically, whenever that has happened, that has led to bad things in the Nifty. And quite predictably, once we got the onset of the COVID pandemic in early 2020, we got a 38% correction in the Nifty. In the same vein, whenever the Nifty's P ratio has dropped to levels significantly below its long-term average of 20, historically we have seen very strong rallies in the Nifty. So for example, after the Nifty crashed by 51% between 2000 and 2001, the Nifty's P ratio also dropped from 28 plus to 12.3. At 28, the Nifty was obviously very, very overvalued and we got a correction. That's understandable. After the correction, the Nifty's P dropped to 12.3, which is significantly below its long-term average of 20. So now the Nifty is very, very undervalued. So ideally, we should see a very strong rally after this. Did we get a strong rally after this? Absolutely we did. As you can see, over the next 7 years, the Nifty went up from 854 points all the way to 6,300 points by January of 2008. So that's a increase of 7x over a 7-year period. If you translate that into annualized return, that translates to a staggering return of more than 35% per annum between 2001 and 2008. The next time the Nifty's P ratio dropped to these super low levels was in October of 2008. This time round, the Nifty's P ratio dropped to an all-time low of 10.68. What happened to the Nifty after that? As you can imagine, the Nifty rallied over the next 12 years from a low of 2,500 points all the way up to 12,362 points. That's an increase of more than 5 times over a 12-year period. Something very similar happened after the initial crash that was witnessed in the Nifty at the time of the onset of the COVID pandemic. After the crash, the Nifty's P dropped from 28 plus to 17.15. This time round, the Nifty's P ratio didn't drop to the super low levels of 12.3 and 10.68 that was witnessed in previous crashes. But nevertheless, 17.15 is still lower than its long-term average of 20. And we can see that after the Nifty's P ratio dropped to 17.15, which is below its long-term average, we saw a very strong rebound in the Nifty after that, starting 23rd March 2020. Now, based on this, what is it that we can infer? We can infer that the Nifty's P ratio has very, very strong predictive powers with respect to the future direction of the Nifty itself, especially when the P ratio of the Nifty is at its extremes. So when the Nifty's P ratio is at super high levels of 27, 28, those are times when the chances of a crash becomes very, very high. And whenever the Nifty's P ratio drops to level significantly below its long-term average of 20, those are times when the chances of a rally in the Nifty goes up significantly. Now, based on this, you can construct a very common sense investment strategy. During times when the Nifty's P ratio goes to super high levels, 27, 28, during such times, you should get out of equity markets or at least cut down the equity exposure in your investment portfolio very significantly, because historically we have seen that during such times, the chances of a market crash becomes very, very high. And vice versa, whenever the Nifty's P ratio drops to levels significantly below its long-term average of 20, during such times, the Nifty is considered to be very attractively priced. And during such times, you should significantly increase the equity exposure in your investment portfolio. So let's try to come up with a tightly defined strategy to incorporate this logic that we can apply to a 5-year SIP. So this is what I want to propose. So what I'm proposing here is that on the first trading day of every month, on the day when you are doing your SIP investment, on that day, you first go and check what is the prevailing PE ratio of the Nifty. And based on the prevailing PE ratio of the Nifty, I am proposing that you should rebalance your investment portfolio every month for a period of 5 years. So for example, if in any given month you find on the first trading day that the prevailing PE ratio is more than 28, we just saw that whenever the Nifty's P ratio is 28 or more, those are times when the Nifty is usually considered to be very, very overvalued. And during such times, the chances of a market correction is very, very high. So what I'm proposing is that if the P ratio of the Nifty in any given month on the first trading day is above 28, then on that month, you completely move out of equity markets. You move your entire investment portfolio to a liquid fund. And you should go to zero equity, 100% of the investment portfolio should be moved to a liquid fund. And then as the P ratio of the Nifty keeps on dropping, I am proposing that you should keep on progressively increasing the equity exposure in your portfolio. So for example, if in any given month, you find that on the first trading day, the prevailing P ratio of the Nifty is between 23 and 28, then for that month, you should have 25% equity exposure in your portfolio. If the prevailing PE ratio is between 18 and 23, for that month I am proposing that you should have 50% equity exposure in your portfolio. If it is between 15 and 18, you should have 75% equity exposure in your portfolio. And if you find that in any given month, if the PE ratio of the Nifty has dropped below 15, then for that month you should move to 100% equity. Also to clarify, the proposed asset allocation that you see on the screen right now is something that I am proposing for your entire investment portfolio, not just for that month's SIP investment. So for example, let's say if the P ratio in this month is, let's say 20, and you have been doing a SIP of 10,000 rupees for the last 1 year. So you have already invested 10,000 into 12, which is equal to 1.2 lakhs. Let's say the value of this 1.2 lakhs has gone up to 1.5 lakhs over the last 1 year. So right now, the prevailing PE ratio is, let's say 20, and you have an investment portfolio of 1.5 lakhs. Now, as per this rule that you see on the screen right now, I am suggesting that you should move 50% of the portfolio to equity, and the remaining 50% you should move to a liquid fund. So you have 1.5 lakhs, 50% of that is 75,000. I'm proposing that for this month, you should move 75,000 to Nifty and you should move 75,000 to a liquid fund. Next month, you will have another 10,000 rupees worth of fresh SIP investments that will come into the portfolio. So based on whatever is the prevailing value of the portfolio as of the first trading day of next month and whatever is the prevailing PE ratio of the Nifty as of the first trading day of next month, I am proposing that you should once again rebalance the portfolio based on the rule that you see on the screen right now. And this rebalancing you should keep on doing on the first trading day of every month for a period of 5 years. Now let's see what's the kind of improvement that you could have achieved in the historical performance of a 5-year SIP in the Nifty by incorporating this market timing logic based on the P ratio of the Nifty in your 5-year SIP. So this is the historical performance of a conventional 5-year SIP in the Nifty. We saw this chart a little while back. As we saw, the worst case return of a conventional 5-year SIP in the Nifty so far has been negative 5.82% per annum, and the best case return of a conventional 5-year SIP in the Nifty so far has been 45.43% per annum. Now let's come to the historical performance of this new strategy that we discussed. This would have been the historical performance of a 5-year SIP in the Nifty had you introduced an element of market timing in the Nifty based on the prevailing PE ratio of the Nifty. Basically, the logic that we discussed just now. With this market timing based logic, the best case return of a 5-year SIP in the Nifty would have been 39.26% per annum, slightly lower than the best case performance of a conventional 5-year SIP. But look at the worst case return. The worst case return of this market timing based 5-year SIP could have been as high as 5.4% per annum. In case of a conventional 5-year SIP, the worst case return was negative 5.82% per annum. What does that effectively mean? That effectively means that by introducing an element of timing in your SIP, you get an investment strategy through which you can potentially get to keep the upside that the Nifty can produce during times of strong bull runs as high as 39.26% per annum. But more importantly, if your 5-year investment horizon, even if it coincides with the period when the Nifty has not been able to deliver, even then with this strategy, you could have ended your 5-year SIP with a return of 5.4% per annum. 5.4% per annum is almost comparable to what a bank fixed deposit would have yielded you. So you get to keep the upside when the Nifty delivers, but even if the Nifty does not deliver, you get to end your SIP with returns comparable to that of a bank fixed deposit. That's like getting to keep the best of both worlds, isn't it? But my dear friends, before you get excited about applying this strategy to your SIPs, I want to highlight to you how this strategy has performed in more recent times, especially in the post-COVID period. We saw earlier in this video that since the turn of this century, we have seen 3 major market crashes in the Nifty. And the common theme across all these 3 market crashes has been that all the 3 of them played out after the Nifty's PE ratio went above 28. And the most recent instance of this phenomena played out during the COVID pandemic. We saw that just before the onset of the COVID pandemic, the Nifty's PE ratio went above 28 for the 3rd time in its history. It was followed by almost a 40% correction in the Nifty after the onset of the COVID pandemic. But once this crash had played out and the Nifty had bottomed at about 7,600 points, after that, a very strong rebound kicked in the Nifty. The Nifty started to go up. And once the Nifty started to rebound, the Nifty's P ratio also started to rebound. But something really surprising happened this time round. This time round, the Nifty's P ratio did not stop at 28. In fact, this time round, the Nifty's P ratio did not stop at 30. It did not stop at 35. It did not even stop at 40. This time round, the Nifty's P ratio went all the way up to 42. And what is even more surprising is that despite the Nifty's P ratio going all the way up to 42, we did not get any major correction in the Nifty after any follow-on correction in the Nifty after the initial downjump in the Nifty that was witnessed during the onset of the COVID pandemic. So how should we interpret this? Should we just interpret that the historical relationship between the Nifty's P ratio and the Nifty that has persisted almost since the inception of the Nifty, which is that whenever the Nifty's P ratio goes above 28, we get a large market crash in the Nifty. Should we just interpret that this historical relationship has now broken down and that this will not really play out going forward in the future? My dear friends, that will not be a correct interpretation. What you need to understand is that the P ratio of the Nifty represents the valuation of equity markets. Now, valuation of equity markets is obviously a very, very important factor that is bearing on the future direction of the Nifty. But this valuation is not the only factor influencing the future direction of the Nifty. There are many, many other factors as well. And arguably the most important of these factors is something called liquidity. Liquidity represents the amount of money that is coming into equity markets. And this is a factor which is so dominant, so powerful, that it can potentially completely overshadow, even nullify the impact of almost every other factor that has a bearing on the future direction of the Nifty, including the P ratio of the Nifty. And that is arguably the reason why the Nifty never really experienced a material correction in 2021, despite the P ratio of the Nifty going to an all-time high of 42. If you really want to understand what exactly is market liquidity, how it played a critical role in ensuring that the Nifty did not experience a major correction back in 2021, despite the Nifty's P ratio going to an all-time high of 42, and most importantly, how we can incorporate market liquidity as a variable in our market timing logic, then please do stay tuned, because this is exactly what we are going to discuss in the part 3 of this series. Now, before concluding, for those of you who want to play around with the data that I have presented in this video, I want to tell you that I have sourced the data related to the historical P ratio of the Nifty from the website of the NSE, the National Stock Exchange. There's one issue with this data that you need to be cognizant of. NSE has basically changed the methodology of calculating the P ratio of the Nifty after 31st March 2021. For the period prior to 31st March 2021, NSE used to calculate the P ratio of the Nifty based on what is called the standalone earnings of Nifty companies. But for the period after 31st March 2021, the NSE started to calculate the PE ratio of the Nifty based on what is called the consolidated earnings of Nifty companies. And this has made things a little tricky because of this change in methodology, the P ratio data as available on the NSE website for the period prior to 31st March 2021 is not really anymore comparable with the P ratio data available on the NSE website for the period after 31st March 2021. These two sets of data cannot really be considered to be a part of the same data set. Now, if you really want to use both these two data sets as part of a continuous series, then you need to make some adjustments. You need to make some normalization to apply some normalization to the data for the period after 31st March 2021. Now, I don't intend to take additional time to explain the details of these adjustments and normalization because that will really make the video very, very long, and I don't think there are too many in my audience who would be interested to understand these details. But for those of you who want to understand the details of these adjustments and normalization that I'm talking about, I've left a note regarding this in the pinned comment accompanying this video. So please do have a look at the pinned comment of this video. My dear friends, this brings me to the end of this video. I really hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video. And one last humble request, please do consider subscribing to my channel. This is something that is not going to cost you anything, but is going to be immensely helpful in increasing the reach of my content. Thank you very much, and I hope to see you very soon in the part 3 of this series.